placing a bigger emphasis on the midpoints of these quadrant levels using the wicks, the new week opening gaps, new day opening gaps, opening range gaps, if the midpoints of these and trading the PD arrays that form over top of those is if there's a greater emphasis on those PD arrays, and if there's maybe some other, I don't know, kind of sauce you can kind of give pertaining to the midpoints, because personally what I've found is I keep a journal of all my winning trades in one space, and I feel like my best trades come from the PD arrays that overlap those midpoints on those given levels. So that was just my what I wanted to know is if there's a greater emphasis on that.
That's a very good question, matter of fact. And if you've been with me for a length of time, can you hear me, by the way?
Yes, sir.
Yeah,
Yeah, we can hear you great, brother.
Okay. So the idea of the consequent encouragement of a wick or inefficiency, and or if it's an order block, the mean threshold. Think about it like this. If something is bearish in our community and when we're watching price action, if it trades up into a PD array, if it trades up into an inefficiency, if it trades up into an order block, what is the common denominator? We want to measure its willingness to stay when we're bearish below that mean threshold, if it's an order block, or at or below the consequent encouragement of an inefficiency or a wick. What this is actually defining is the highest high and the lowest low. And if you know what you're looking for, you can get the perfect entry on a real turtle soup rather. You'll be able to enter in on a very low. For instance, let's consider. Look at your 9:48 a.m. 1 minute micro E-mini Nasdaq. Now, just so you guys know, I'm going to stay with the micro because I know I'm influencing people. So if I'm using a micro contract chart, a lot of the guys won't feel so silly about doing it themselves. So I'm trying to really push this measure of personal responsibility and also risk. But if you look at the 9:48 a.m. candlestick, and it's a 1 minute candlestick, we have a wick. It's a discount wick. And the close on that candlestick comes in at 25,262 and 3/4 or 0.75. The low comes in at 25,251 and 1/4 or 0.25. If you measure that with your fib, put that Fibonacci on it, you're going to get a consequent encroachment level of 25,257 even. Notice that the low on the very next candle at 9:49, that candlestick's low comes in at 25,255 and 3/4. That's one tick away from the eighth at 0.625. If you put that in your fib, it fails to get there. So is that bullish or bearish? It's bullish. Why? Because the body never even touches on candlestick number, candlestick at 9:49 a.m. Eastern time. The low fails to get to an eighth. The body's never even touched the midpoint or consequent encroachment, and it goes right back above 9:48's candlesticks open. So it's a shift. So that opening price at 9:48 becomes what? Change in state delivery. Look at the candlestick at 9:50. What did it do? It opened, trade down consequent, I'm not consequent encroachment, to change in state of delivery, which is the opening price at 9:48. Then you get a price run as you would expect if it's algorithmic. If it's really going to be algorithmic, you should start seeing displacement to the upside, and it runs. Now go back to your question, consequent encroachment, midpoints, and all that stuff. You can measure real accumulation and distribution when prices trade in extremes by how it reacts or if it even engages at all at these midpoints. If you're bullish, if you're anticipating bullishness, and why would you anticipate bullishness here? You have a low at 9:42 a.m. that we pierced at 9:48. So that's potential. You're in territory of what? Turtle soup. So if you look at my examples I've done over the years where I'm actually live trading and doing entries and really, really tight entries, many times I'm using these wicks. When I tried to teach this concept and calling it as a wick, it caused a lot of confusion, referring to it as a gap. But it's the same premise. It's not a static range like a candlestick body is. It's something better explored on a lower time frames. By that, I mean, if you look at the wick, whether it be a premium wick above a candlestick or a discount wick below a candlestick, the entirety of that range that defines what the wick is, if you look at lower time frame charts, you're going to have a whole new universe to explore with microstructure. It's so beautifully done on 5 second, 15 second, 30 second charts. Like it's like unbelievably precise. But you frame this idea on whether you think the market's bullish or bearish. So to answer your question, there is absolutely a large degree of importance and significance attributed to consequent encroachments or mean thresholds for order blocks. It helps with many things. It helps with timing. You'll get some of the best entries that you'll ever see in trading. You'll also know how to better define your risk and where to place your stop loss orders. You'll also know when to anticipate a turtle soup changing direction and then defining how you can use, for instance, like here, pyramiding a new entry using the change in the state of delivery on the opening price at 9:48 a.m.'s candle. But it's all contingent upon how it reacted off of the consequent encroachment level at 25,257 even for the 9:48 discount wick. So these are things that I encourage all of you as students to not just say, okay, I see a wick there. How many times have you spent going through your chart from the previous session or day and go through it and say, okay, here's where the wick was here on that and measure that. And what was the effects of price action after it created the wick? How many times does it go down to 1/4 of the wick, half of the wick, 3/4 of the wick? How many times does the wick get pierced and taken out with another lower wick, but then does what you expected it to do, go higher or lower? You'll overcome a fear of, because this is the first fear creeped in to me when I was thinking about this. I'm thinking, okay, I have to be able to represent this phenomenon I'm noticing in a way where it's visible, where I can say, okay, it's now the same stage that this happened the last time. And it was always inside these wicks. So by having an understanding of noticing the wick and paying a particular attention to them, you have to explore inside of them. And if a market is bullish, okay, smart money concepts, ICT concepts, me, Michael, the way I define order flow being bullish is everything that would constitute something that would be support in nature, a discount sensitivity, something that's going to be a discount PD array, something that's going to keep price from going any lower and it should react bullishly higher. It's going to operate in its upper half. It will not explore in its lower half. So what does that by definition highlight? The midpoint consequent encroachment or mean threshold. So there's a huge, huge mine to explore in there. And I have yet to exhaust the information I can get from these things when I do it. And I've been doing it for 34 years.
Huge. Midpoints, I mean, Michael, that's huge. I mean, in my opinion, that's huge. Mean threshold, so important for the trader. So important. Wonderful, wonderful. Tommy, did we answer your question?
Yeah, thank you, Michael. Appreciate it.
These quadrants are actually a framework, you know.